G'day expats, welcome to another episode of Expat Chat. We're here with Brett Evans, the Managing Director of the EMEA region. Brett, how are you going?
Hey, all well, thanks. All well. And for the folks out there, joined by my colleague and mate, James Ridley, who is the Master of the Asia and Americas region for Atlas in the Australian office. How's things back home, mate, apart from cold?
I'll take that title. Man, it's good. Busy. You being over there, you'd be dialed into just the sprint finish that we're in right now for the end of the financial year. Yeah. A lot of clients finally finishing off their strategies for the year and just general things. You constantly just see the end of financial year sales going up, and it seems like scams right now, especially to do with the ATO. There's just a lot of scams going around, a lot of phishing emails, a lot of cybersecurity items actually at the moment. So it's just pretty common this time around, I suppose, with just that key date, 30th of June. But other than that, it's not too cold. I think we had a very, very cold week last week. Average days on the Gold Coast in the morning at 7 a.m., 6 degrees. That's almost unheard of, unconscionable. But I guess, mate, I wanted to talk about a really good topic today. Just because a lot of my clients, as well as a lot of, I suppose, the region that I focus on, the APAC region, especially in the US, a lot of those types of the Aussies over there, they are lucky enough to receive stock or equity compensation through their employment package. So really good topic I want to talk about today. Before we get into it, I just want to celebrate the fact that this is episode 50. Yes. Obviously a terrific milestone, and can't wait till we're ticking off the box for 100. Hopefully that's just around the corner. I think getting to 50, that's terrific. Let's tick off 100.
Sounds good, mate. And let's get the housekeeping out of the way. So all the information that everyone has the fun and the pleasure of listening to today should be treated as information and educational purposes only. If you need personal advice, speak to someone who has a license, who has experience, like Atlas. Also, too, just a heads up too, we're working on a pretty average internet line here. So for those who are watching this on YouTube, you may see our mouths not match with the audio. And for those who are listening on podcasts, you may hear little gaps. So we should be okay. We're resetting routers and stuff like that. But it's more important to get the information out there. So we'll power on. But the quality may not be as great. So, mate, let's talk about RSUs, ESOPs, all the game and how Australian expats need to really pay attention to this, because it is essentially the golden goose, but also too it can be the noose, which I've just made it up very quickly. So it's the golden goose and the noose.
I don't mind that one actually. I might steal that one, trademark it before you can use it again. Mate, want to do a quick shout out. Those that have been sending the feedback on the podcast, love it. They've been great. So this is actually driving some of the topics. Not today's topic, but there's actually a bit of a list building up. So terrific. Keep sending them in. We love it. And we'll keep improving. Also just our microphone and those sort of things. A few people querying in on that one. But listen, restricted stock units, options, share appreciation rights. These are common sort of terminology items that get thrown around, especially in the US, as part of your employment package. And essentially, once you start working for an employer in the US or Singapore or wherever it might be, you get a bit of a sort of, you always get them dumped on you, and then you hold them and then they vest, usually on a quarterly basis after, say, a 1 or a 3 year sort of period. There's usually what we call a vesting cliff, where once you sort of met this milestone after a certain period, they all vest to you, and then you can do what you want with them. You can sell them, you can hold them. In that period when they're vest to you, it's very common that they can be treated as ordinary income. However, it just depends on the country that you're in, how they're treated. I know, as an example, in Singapore, you can be gifted all these employee shares for the period that you live in Singapore, not actually pay any tax on them. But when you actually leave Singapore, that's actually when you have to pay a bit of a final tax on all these RSUs that you've received for whilst you've been a tax resident. And it's not treated as capital gains, because remember, Singapore doesn't have capital gains tax. It's actually just treated as ordinary income. So a lot of people get caught out with that final little exit tax that they're unaware of. But the US is probably the main area that we'll probably talk about, just because of the big tech bubbles over there. And the reason why this topic has come up is share market volatility. We've entered a tightening cycle. And it just means that certain sectors don't perform that well compared to sort of some of your industrials, infrastructure, those kind of asset classes through this period. And I know a lot of clients of mine, they've been doing the smart thing, liquidating when they can, tranching, dollar cost averaging, those sort of things. But there would be a very large Australian expat base in the US or Singapore that, they receive these RSUs or these shares as part of their employee share purchase plan. They don't do anything with them. They just hold on to them and let them grow, which is great. But over, say, a 5 to 10 year period, all of a sudden, I'd say majority of your wealth is now tethered or tied to this one stock.
Yep. One company, one performance.
Exactly right. And gosh, what an emotional roller coaster that must be. Every month you check out your statement that you get sent from Charles Schwab or Fidelity. Holy hell. Yeah. So I guess why I'm talking about this is, yes, share markets will pull back. Tech stocks, which we consider growth stocks, they're in the toilet right now. I think Facebook or Meta, as an example, that's dropped 49% since the start of the year. So all that growth that you saw from sort of, I suppose, when COVID hit and then share markets on a big tear, that's gone. That's been eroded. That's no more. It's pretty much back to 2018 prices, maybe 2017, the sum of those types. And those that have ridden that wave, still holding on to those shares, well, they haven't done the smart thing. They shouldn't be tying all their wealth and their future to one stock. They should be doing, I suppose, the sensible thing where, okay, a portion has vested. So why don't I liquidate that tranche, pay a bit of tax, but then diversify across different asset classes or different strategies? That might be, yes, a diversified share portfolio aligned to, say, your investor profile. That might be putting a little bit away for your retirement, in one of your retirement assets, paying down some personal debt, or, buying a main residence, where it just depends on what your goals are. But this has been the biggest issue probably this year. A lot of people probably entered 2022 expecting that share markets would just keep going on this great bull run. But now that inflation has definitely popped its head up and climbed the fence, and interest rates are now moving, a lot of people have, yes, there's a great sort of line you like to use, Brett, about the tide, when the tide goes out.
You see who's swimming naked. That's exactly right. Yeah. And I think what you're hitting, nail on the head 100%. To me, is more behavioural finance issues.
It is,
as opposed to pure statistics or structural issues. And I said this to a client a couple of years ago who was working in London, same sort of deal. And I said to him, okay, when it comes to being able to sell your shares that have vested, what's the process? And they said, well, we've got these windows that open up. So yes. I said, well, this is great, because what it means is you can be undisciplined. You can be disciplined in the way that you rationalize your assets. By that, I mean dollar cost averaging. So anytime a window opens, you sell 5%. And then every time the window, whether the price is high or low, you don't know whether the price is high or low till after the fact. And if you sold Facebook 12 months ago compared to now, you look like a genius. But I guarantee when you sold it 12 months ago, you would have gone, oh, there's still more to go. You don't know what's coming around the corner.
No one knows that.
So the importance of diversification, I mean, both across asset types and currency and, geographically speaking, it's important to have that mix. I was talking to a client yesterday and he's like, oh my God, the Australian share market fell, 2%. And I said, well, and so did the Australian dollar. So therefore your US dollar assets are a square. He's like, oh, I didn't think of that. Yeah. And I said, that's why we have diversified portfolios. That's why we have things in, I think last count, when you include all the ETFs and direct equities, like exposure to 1,650 companies around the world, for the basic fact that 1,650 companies have to go bust in order for you to lose all your money. And if that's happening, honestly, we're living in caves eating baked beans, because if the top companies, if the top 2,000 companies in the world collapsed tomorrow, we're talking about Armageddon. So that's why it's great to have that diversification aspect. We never know when a big company may go bust. And people say, oh, no, it's too big to fail. No. History has shown us the biggest companies at the time sometimes have a weakness. And you don't want to have all your eggs in that one basket. Even if the share price keeps climbing, you need to be able to spread your exposure across, different assets, different currencies, different economies, different markets, because then it reduces your reliance on the jockey on that one horse when you can place bets across the whole field.
Yeah, that's right. And I mean, this week's been obviously a very volatile week, just with the FOMC meeting that was held last night. And US got a 0.75% increase, but he's sort of trying to front load those interest rate rises to buy themselves more time sort of down the track. And that's what they want to achieve. And you actually saw most share markets, funnily enough, breathe a sigh of relief after that. They're like, oh, okay, cool. And then Wall Street shifted.
The talk was 1%. They were going to go really front load it. That was going to be one of those big Caterpillar diesel, front loaders and just dump it on there. So it was an interesting one where it was sort of, it's like that scenario where, a company loses 10 billion and goes up 15%. And the client says to you, they've just lost $10 billion. How the hell's it gone up 15%? I said, easy. The market was expecting to lose 20. And it's the same thing with interest rates. The market was expecting that possibility. Expectations. It could have been 1%, but now it's only 0.75. Thank God for that.
I know. Well, I mean, I don't want to dwell too much on interest rates and all that sort of stuff because we've done that before. But it's funny, just expectations around the market, when it beats it, when it doesn't, and it's just purely investor sentiment. But I mean, as we all know, share markets, they are just one of the, it's probably the only, I suppose, an efficient market is just the best kind of pricing mechanism. But the share markets, it does it instantly. Property markets, it takes 12, 18, 24 months to see the effects. And it's interesting what's being talked about the property market probably over the next 24 months, where it's going.
There's some big headlines coming out, isn't there?
There is, because we had that interest rate movement last week. It's usually from one of the big four bank CEOs or something. One of the big top dogs have come out. No, we expect 20% drop. Blah, blah. So it's going to happen. I think it'll slow things down.
I've just got to give myself some credit too, because I've called it one for one so far. Remember I said in the previous episodes, I said rate rise in May, rate rise in June, and I called 50 basis points in June. And then I said another 50 basis points in July, and then possibly 25 in August. So at the moment, I'm on track. So
you're on track.
And we'll know in that 2 weeks' time, whether there's another 50 basis points coming through from the RBA. But I think everything shows it. Everything shows it.
I think that means I might have to send over a carton of beer if you can smuggle it into the middle to UAE.
Yeah, that's right. Yeah, I won't make you pay for it here because it costs a fortune. You're going to pay your 30% tax on top. But we can go up to RAC, up to Barracuda. Get over the folks up there. We don't charge alcohol tax, and you just go do the cannonball run through Sharjah. So, mate, you're over here in September anyway. So the bet's not payable yet. The bet's not payable yet. It's still 2 more months to go.
Yeah, but I mean, you look at the movements on the share market today. The last sort of week. I mean, Atlassian at the start of the week dropped 15% in one day. That is huge. I know some of the other big techs have done that, but it's also been on that same trend for, say, the last 4 or 5 months. So the fact that it had one day where it drops 15%, if you were an employee that's been holding all your wealth in just the Atlassian stock, well, you go back and it's probably back at 2018, 2019 prices now. So if you had a plan and your plan was to routinely sell down tranches every quarter going back 2 or 3 years, you would be significantly ahead compared to now. Exactly. You would. That is the reality. And we're going to do a white paper on this and compare a few different scenarios, and the proof will be in the pudding. The data's there that
numbers
if you diversify and again, not becoming emotionally attached to this one stock, taking a sensible approach and diversifying, then yes, you would be further ahead, I would say, in life right now compared to 3 years ago if you just kept and let it run. Things don't always just run consistently. And you'd have different assets, different exposures, which would have been helpful as well, especially through downturns. So it's just, again, I'm just driving home the point here that inaction is costly. And we've seen that this year.
Yep.
And I'm having a lot of inquiries and consults of late that there is a key theme there, holding RSUs, holding options that they haven't sort of, I suppose, exercised just yet because, well, they technically should right now. But that being said, yes, inaction is very costly, especially from where you could be compared to obviously doing something. So it'll be a good series that we'll put out, this white paper. So a few of us working on it. So I can't wait to get that out to everyone out there. It'll just be a good read. And again, it's just reflecting on how costly inaction can be. Doesn't necessarily have to be tied to stock compensation, but expats, as we always say, should not stick their head in the sand. They should have a plan or a strategy for when they do get into their new country. Well, what's the plan? Get settled first couple of months and then set things up, automate it, make your life easier by automating things.
I think people can see a pattern here. For us, dollar cost averaging works across so many fronts, whether it's currency transfers. And I'll give a case in point. 2 days ago, the dollar hit, 60, 68, 69 cents to the US dollar. Now it's back above 70. Whereas if you were disciplined on the 15th every month, transferring your cash, you would have got that. And now you look like a genius because the currency's popped back up again. So take the emotion out of it, but apply structure. So it doesn't mean to sell it and go off and do whatever you want. Have a process behind it. If you are taking out 5% of the balance when your company window opens, do that every time the window opens, whether it's every 6 months or 12 months. And then you just know it's happening. Let's go this, let's do this. So that to me is a big part of what we just try to educate folks on. We see it on a daily basis.
Absolutely.
It's like it shoulda, coulda, woulda. There's scenarios where people should have done this and we look back and go, not only you, but 50 of other people as well should have done it as well. If everyone did it, it'd make life easy for them.
I mean, when I look at just portfolio management and when you hold a diversified portfolio, yes, we know that Meta, that's dropped nearly 50% since the start of the year. Amazon dropped pretty close to 35 or maybe 40%.
Atlassian, Canva, the whole lot goes on.
Atlassian's down a huge amount. Yeah, the list goes on. If you had a diversified portfolio, which took into many sectors and many regions, yes, I reckon you'd still be down, and I think you'd be down close to 10% depending on your risk exposure. So just the kind of investor you are, growth, balance, high growth, whatever it might be. But there are still areas that are performing. Good example, BHP. BHP for the year to date is up, surprisingly. And it's just because it's one of those sectors which,
doing well.
Because of it's doing well. Commodity prices have shot through the roof, and that's why it's doing well. The energy sector, oil, gas, those sort of things. So when you hold a diversified portfolio, you have a good piece of that exposure, and that helps cushion the portfolio in the fact that you're not dropping as much as 49%. It's just these key things that expats they need to think about when they're investing. And again, it's just going back to the fact that doing nothing isn't a strategy. No. That's not a plan, doing nothing. So around this, yes, inaction, as an example, has been costly for a lot of those types of expats. Still not too late to make things change, but again, you need to really get off your ass and do something.
Learn from history, and I think, the final comment on that would be, she'll be right isn't a strategy. You need to actually take the bull by the horns and do some stuff with it. So, Matt, I think we wrap it up there. A little bit of housekeeping.
Yeah, Matt.
Once again, following from what James said before, keep up the feedback, guys. Keep up the Q&A. Loving it. We haven't seen some reviews recently, so if 5 or 6 of you could just quickly chop on there and give us a review, love that for it. And next week, we'll be holding a end-of-year review webinar. Pretty much going to run through the past 12 months, the next 12 months, property, shares, currency, and we'll also be providing an update on the tax residency changes under the Labor government. So make sure you register for that in the links down below in the show notes. Mate, let's wrap it up there. So
sounds good.
Awesome to catch up with again, mate, and we'll see you on the next episode, 51.
Sounds good, mate. See you then.
Thanks, mate. Take care.